Right now, crypto assets in total, all digital assets, are a $4 trillion market. Global real estate, 400 trillion. Global debt, 300 trillion. Global equities, 100 trillion, etc., etc. Gold, 20 trillion. Now, Bitcoin probably replaces gold. Okay, so we know where Bitcoin's going. But the rest of it is going to account for the other part of this equation. And that comes from this total market cap of the entire space. If we just use the same log adoption channel, which works in everything, and we've shown it, it tells you we get to 100 trillion in value by somewhere like 2032 if we just follow the fair value curve. So by 2032, 7 years from now, this entire space is $100 trillion.
Every so often, financial history offers a moment so massive that it dwarfs everything else. A shift that doesn't just create wealth, but rewrites the rules of money itself. Right now, we're living through one of those moments. Today, the entire crypto market sits at roughly $4 trillion. That may sound like a big number, until you compare it with the $400 trillion in real estate, $300 trillion in global debt, or even the $100 trillion equity market. In that context, crypto is still a rounding error, just a few drops in an ocean of capital. But according to Raoul, one of the most respected macro investors in the world, this will not last. Pal argues that Bitcoin alone is poised to rival and eventually replace gold, currently a $20 trillion market. And beyond Bitcoin, the entire digital asset ecosystem is projected to balloon toward $100 trillion by 2032. If that sounds ambitious, it isn't just a guess. It's based on adoption curves that have worked consistently across every network-driven technology in history, from the internet to mobile phones. If the same trajectory holds, crypto isn't just another asset class, it's the greatest macro trade of all time. This perspective is why Pal describes crypto as a supermassive black hole that pulls in capital, talent, and innovation at an accelerating pace. In his view, no other market trend even comes close. While traditional assets like bonds or small caps quietly erode in the shadow of monetary debasement, crypto and technology not only survive, they thrive. The exponential math is simple. Scarce digital assets plus relentless network adoption equals historic returns. In today's video, we'll hear directly from Raoul as he breaks down why debasement is the defining macro force of our time, why diversification no longer works in the way investors were taught, and why crypto's network effect is set to capture trillions in global value. If you're serious about positioning for the future, this is a discussion you can't afford to miss. So make sure to hit the like button, subscribe if you haven't already, and stick around until the end. We'll break down the numbers, the logic, and the enormous opportunity that lies ahead.
So take into account everything we know about debasement, that it is the massive macro factor, that it drives all assets, including the business cycle, that it's all related. So everything is correlated. So when you start to come that understanding, you start to think, what is the point of diversification? You start to think, actually, what I should be doing is using the most powerful macro variable we have ever had, literally in the history of macro, and it explains most of the price moves. So therefore, we trade that. And by trading that, we start looking for what is the asset you want to own? How do I make the most returns from this incredible macro opportunity? And we call this the supermassive black hole. This is why a bunch of macro guys like Julien and I in crypto. It's why we've ended up in technology stocks. It's this that is the key factor. And this is the mega trend that you need to be aware of. This mega trend, if you think about it, what is debasement? Debasement is scarce assets going optically up in price because the denominator, fiat currency, has fallen. But the issue that's affecting society globally is that wages and earnings are driven by GDP growth and not debasement. This is why inflation and debasement are two different things. So what we found is that earnings, household earnings, corporate earnings are driven by the business cycle and GDP growth. But the debasement drives the assets. Now, the debasement is at 11% a year and GDP growth is at 2% a year. So what you get is everybody getting poorer. the amount that their earnings buys of, whether it's gold, which is the nice pure way of looking at it, is less every year, all of real estate, or of anything, which is why house prices are so expensive now. It's all based on the debasement and the fact that it doesn't help your earnings, which is why we talk about unfucking your future, because you are so fucked if you don't have long duration assets like crypto or technology in your portfolio, because you're just not getting ahead. In fact, you're really hampering yourself. So we'll come on to a bit more of that in a sec, because it is the key killer point for you guys and unfucking your future. And while you feel that the world is running away from you and you can't catch up. So when we look at NASDAQ versus total liquidity, so this is the outperformance of NASDAQ versus total liquidity. We can see that it's been doing about 13.8% in excess returns. So you've been handsomely rewarded by NASDAQ. Why? Because tomorrow is going to be more digital than today. So many people are so stupidly scarred by 2000, when this has been the greatest bull market in history, is the NASDAQ, going back to 1985, 1990. And yet people still miss it because there was once a bubble that burst. But even then, returns have compounded massively over time. So that looks good. We understand technology investing. We understand the rise of these new giants. We're seeing the change from the internet world to the AI world. That's driving excess returns again. But when we think of Bitcoin, it's actually driven 94% a year excess returns over the rate of debasement. So you've got this asset that is in la la land in returns versus anything else. It's 144% annualized returns. That's including all of the drawdowns. So all of the bullshit nonsense about Bitcoin's too volatile, it's a bubble, it's going to burst, that happens every cycle. People don't understand it's the duration of your investment that matters. If you have a long-term time horizon, those pullbacks are actually what you look forward to, because you can buy more at cheaper prices. Or you can, if you want to, reduce risk from the cycle. I've done both, and I found, generally speaking, if you don't need to take lifestyle chips off, it's better to have the drawdowns and not try and time them, because I've done that too, and that's not the easiest one always. And it's also very difficult to put back in what you took out at the peak. You know, if you've taken out 100 grand at the peak and the markets are crashing, everybody hates crypto, you think everybody's going to prison, the last thing you want to do is put your 100 grand at risk back again. So you always do less, and you end up actually lowering your returns over time as opposed to adding to it. So you've got these assets that are cyclical, that have this incredible adoption rate that well in excess of the debasement of currency, which is crucial. And Bitcoin is the one. But let's first look at our asset management firm, XPAM, where we invest in a broad basket of crypto hedge funds. What we're trying to do within XPAM is capture the trend move from $4 trillion of market cap today to 100 trillion. That won't all be driven by Bitcoin. In fact, Bitcoin dominance over time will change. We're trying to capture the mega trend. That mega trend is so powerful because it's how you unf your future. Now, if you look at all of the assets on this table, what we've got is everything in orange here underperforms the debasement of currency. So you're actually getting poorer by owning small caps, REITs, treasuries, preferred, high yields, investment grade bonds, everything, unless you're using leverage. There's only a few. The SPY, well, really, that's in line with debasement plus inflation. So when we're looking at those, you've actually only got two asset classes, technology stocks and crypto. And within crypto, you've got these ridiculous returns where Bitcoin since 2012, we didn't go 2011, we didn't go back to 2010 or 9 because the numbers get too stupid, has annualized 130% with that 64% drawdown, 73% drawdown, and 56% drawdown. Ethereum is doing about the same, about 133%. And we expect it to outperform in this cycle as it has done in all of its cycles over time. And Solana is currently, because it's newer in its adoption model, has been outperforming Bitcoin. And then if we were to add SUI in here, which Julien and I are heavily invested in, that has outperformed Solana because it's earlier in network adoption, where you get the steeper part of the adoption curve.
What Powell lays out here is critical. The destruction of fiat purchasing power through ongoing debasement isn't just pushing assets higher, it's actively making wage earners poorer. Household income grows at just 2% per year with GDP, while currency debasement eats away at 11% annually. That gap is the silent engine of wealth inequality, and the reason why simply holding cash, bonds, or even broad equities isn't enough. To protect and grow wealth, investors must own scarce, long-duration assets. And in today's world, that means technology and crypto, with Bitcoin leading the charge. But this isn't just about holding Bitcoin as a hedge. It's about understanding why this space is structurally designed to outperform everything else. As Powell notes, crypto isn't merely another cyclical asset. It's a network adoption model, much like the internet or Amazon in its early days. Which brings us to the next critical insight: why the adoption curve of crypto is not just strong, it's the fastest in human history, and why that matters for the next decade of wealth creation.
So when you want to your future, you start to think about, okay, I've got crypto and NASDAQ. And I know a lot of you right now are all trading tech stocks because Bitcoin's been in this kind of sideways chop period. So you're all piling into tech stocks. Julien and I have tons of them in the portfolio. We love the technology trend. It's a really easy trade, has been an easy trade. But if you're honest with yourself, if you were to own one or the other, then you find that the NASDAQ has underperformed Bitcoin by 99.94%. What is the point of owning any other asset? This is the supermassive black hole of assets, which is why we personally are all in on crypto, because this is the big one. This is the greatest macro trade of all time. This is why many of the greatest macro investors of all time have moved across to crypto, because it is such a powerful trend with such powerful returns, and the cyclicality makes it also tradable. It's also the most powerful, the greatest macro trade of all time, because it's driven by network adoption. Remember, Metcalfe's law is driven by the number of users and the total value transacted on a network. Go back to Amazon, a perfect network adoption model. Metcalfe's law drives Amazon. People don't understand the valuations of Amazon back in the early days. You see, what happens is they had a number of users and they were only buying books. So the total value of transactions was low, but there was a lot of users. They started adding new products in. The value transacted on that network exploded. As they did that, the number of people using it exploded. That is what drives these incredible log charts of all the technology stocks. It also works in crypto. By the way, sorry, I forgot to mention before, we talked about this debasement versus earnings. That is why you see all these people, old school analysts, screaming about P ratios. P ratios are back to where they were in 2000s. Everything's going to crash. You don't understand. Earnings go with GDP growth and price goes with debasement. P ratio always goes up in periods of debasement. That is how the world works.
Which is why valuations look expensive today, because prices are rising with debasement. Earnings are still subdued because the business cycle is subdued. So basically, all that needs to happen between now and next year is earnings need to rise to justify the valuation premium, which is already baked into equities.
But PEs will still go up.
Correct.
There's different valuation. PEs will go up, but it won't go up as fast. But it's been driven by this debasement trend. So, okay, let's go back to this chart. This chart is a killer chart, and everybody mid-curves this. This is total internet users in millions from 1992, when there was first 5 million users of the internet, and crypto users 2016, when there were 5 million. Now, we use wallets as active wallets as a proxy versus active IP addresses. Are they perfect? No. We all have lots of wallets. We all have lots of IP addresses. It is the direction and the rate of change that matters. The internet grew at 76% a year and then started flattening down to about 43% a year. That's very typical of network adoption models. Crypto has been growing at twice the speed of the internet. We will have 1 billion active wallets, and we can proxy that for active users. Yes, there's less active users. I get it. Doesn't matter. Don't get caught on mid-curving it. What it's saying is it's growing twice the speed of the internet. This is the fastest growing technology in all human history up until AI, which is dwarfing it already. But the difference between AI and crypto is you can't own crypto. You can't own AI very easily, and you couldn't own the internet. But here, you're getting a token in the infrastructure layer of the entire new internet, which is blockchain. And blockchain is not just about Bitcoin. It's not just about Ethereum. It's about all of the use cases of these various chains. We've seen the same with cloud compute, and that's split amongst tons of companies. Yes, there'll be some giants. There'll be some fast adoption. There'll be new use cases. It's all coming. And don't forget, here we're still in the speculation plus stablecoin phase. We haven't started really putting real world assets on chain. That's coming. We haven't even started putting Web 2 into Web 3. That's coming. That's a mega trend. That'll suck in the next rise, which is by 2030, we think we get to half the world's population having crypto wallets. Again, don't get stuck on the metric. What we're saying is the growth continues massively, and it will continue to massively outpace the internet. It's basically the future of the internet with different rails. It's the read, write, own rails of Web3 that will become increasingly important for things like digital identity, how AI agents interact, how the financial system operates, how the system of money operates, how collateral operates. It's all this. So this is the mega trend. This is why we're trading it. This is why it's outperforming everything. Okay, so we go back to this thesis at Xpan that we have that right now, crypto assets in total, all digital assets, are a $4 trillion market. Global real estate, 400 trillion. Global debt, 300 trillion. Global equities, 100 trillion, et cetera, et cetera. Gold, 20 trillion. Now, Bitcoin probably replaces gold. Okay, so we know where Bitcoin's going. But the rest of it is going to account for the other part of this equation. And that comes from this total market cap of the entire space. If we just use the same log adoption channel, which works in everything, and we've shown it, it tells you we get to 100 trillion in value by somewhere like 2032, if we just follow the fair value curve. So by 2032, 7 years from now, this entire space is $100 trillion. If we go above that one standard deviation, it gets there faster, or it gets to a higher valuation by 2032. So that is an astonishing opportunity, considering we're only 4% of the way there. That's how you need to think about this. Then you need to think is, what is the structure of the crypto market going to look like? Well, Bitcoin will be the sort of percentage, let's say, that gold is of total assets. Well, total assets here is, somewhere close to, I don't know, if I'm looking at it, 500, 800, call it 900 trillion dollars, and gold is 20 trillion. So Bitcoin will be somewhat similar of the new system. So what we're seeing is the game is yet to be played in much of the component parts of this. That's including the applications layer as well. Who's building what on this? This is what's making it such an incredible thing.
Here's where it all comes together. When Pal compares crypto to the internet, he isn't speaking in metaphors. He's mapping the actual adoption data. The internet grew at 76% a year before slowing down to 43% as it matured. Crypto, however, has been growing twice as fast. By 2030, half the world could hold a crypto wallet. That's billions of people transacting, saving, and building on blockchain rails. And unlike the internet, this time, you don't just use the technology, you own a piece of the network itself through tokens. The implications are massive. Bitcoin, with its pristine scarcity, takes the role of digital gold and ultimately rivals gold's $20 trillion valuation. Ethereum, Solana, and other smart contract platforms capture the applications layer, the new financial plumbing for everything from payments to tokenized assets to AI agents. And stablecoins will quietly replace huge portions of global settlement and dollar demand, effectively making blockchain the backbone of the new financial system. Some argue that governments and TradFi giants like BlackRock will attempt to co-opt this revolution. And they will. But that doesn't mean Bitcoiners are wrong. History shows that every wave of financial innovation is first resisted, then absorbed, then built upon. The US government may lean on stablecoins to strengthen dollar hegemony, and asset managers may package Bitcoin into ETFs for the masses. But none of that stops the core truth. The networks themselves remain decentralized, borderless, and increasingly unstoppable. Bitcoin cannot be confiscated or inflated away. Ethereum's decentralized applications can't be shut down with a single order. This is why Raoul Pal and other macro giants describe it as the most powerful macro trade in history. So what does this mean for investors today? It means we are still early. At $4 trillion, the entire crypto market is only about 4% of the way to Pal's projected $100 trillion fair value curve. The cycles will bring volatility, yes. There will be bubbles and crashes, no doubt. But zooming out, the trajectory is undeniable. For those who understand the math, the network effect, and the macro forces at play, the next decade could mark the single greatest transfer of wealth in modern history. That's why Raoul Pal says, bluntly, this is how you unf your future. By owning the assets that outpace debasement. By holding the networks that scale exponentially. By ignoring the noise and focusing on the signal. And drop a comment below. Where do you think crypto will be by 2032? If you found this video insightful, don't forget to hit like, subscribe to the channel, and let's keep building conviction together as this incredible macro story continues to unfold. Thanks for watching.